Happy to have you all here. We do have a guest speaker today. She's Miss Marjorie McPike. She's been a CPA for 15 years. We're going to leave it open for questions. And if you guys have any, you can type questions in the chat box. She's going to cover like a brief PowerPoint covering just tax strategies and different tax stuff. So we appreciate her coming out, and you can share. You should be able to share a screen. So you can go and get started.
Anybody can see my screen?
Yeah, everybody can see your screen.
Okay, awesome. So, okay, so hello everyone. My name is Marjorie McPike. As Daniel mentioned, I am a CPA. I've been a CPA since 2007, so 15 years. We could actually say 15 years because I should have been a CPA in 2006 and they messed up on the scoring of one of my exams. So I'm going to take the 2006. But thank you so much, Daniel, for having me. Feel free to ask questions in the chat as we go through it. And hopefully, I'm sure you'll find it informative and that it'll help you as you go along in your business ventures. So what I'm going to be talking about today is basics of business accounting, and my name is Marjorie McPike. So I have a Bachelor's of Science in Accounting from San Diego State University. I am born and raised in San Diego, not many of us around, but I am one of those. I also have my Master's of Taxation from Golden Gate University, and I'm a CPA licensed since 2007. So the agenda for today is we're going to talk about entity structure, go over some bookkeeping basics, common forms issued or received, and then we'll kind of touch on tax planning. So entity structure. So this is an important one because a lot of, as you're starting your business, you want to make sure that you're structuring it appropriately for the type of business that you have and the type of income that you're anticipating. And, you know, if you have more than one person and for tax planning purposes. So entity structure, it depends on the type of business, the number of people, capital structure, debt, loss, entry and exit, and etc. A lot of people are starting LLCs, which it's good to form an entity, but you can't just stay at an LLC. You may need to evaluate if you need to change your structure. So there are various types of entity structure. So the simplest one to start is a sole proprietor. And with the sole proprietor, the income is reported on Schedule C. So most of you know that. You just kind of go out and you start a business. It's reported on Schedule C, and you'll have to pay self-employment taxes. One thing with a sole proprietor that I should mention is that if you are doing business and you're receiving a 1099 and the 1099 is going to be coming in your name, you're going to report it on a Schedule C. So if you're in that situation, you want to kind of start thinking about what you can do differently so that you don't have to pay so much tax. An LLC, a single member, it's a disregarded entity. The income is reported on Schedule C, just like as if you were a sole proprietor. And you're subject to self-employment taxes. So a lot of people that are forming entities, they're going out and they're just forming an LLC and not realizing that the only thing that the LLC is doing is changing their liability. It's protecting them from liability, but it's not doing anything as far as taxes are concerned. So it's good to have that entity, but you want to make sure that you're structuring it appropriately so that you're paying the least amount of taxes possible. That's the goal. So an S Corp is a corporation that's elected to be treated as an S corporation, and an S corporation is a pass-through entity. So what that means is that the S Corp prepares a tax return and it issues a K-1 to the shareholders. And on that K-1, it's going to have your portion of the income and expenses, or the net income and expenses that you're going to pick up on your tax return. And so you're going to pay tax on that. One of the benefits of an S Corp is that you can have wages. So you're actually required to pay yourself wages as an S Corp. You're supposed to take a reasonable salary. And with that reasonable salary, it allows you to do different things when it comes to tax planning. S corporations, when you take money out of an S corporation, if it's not salary, it's a distributions, and distributions are not taxable income as long as you have the basis in your S corporation. And an S corp shareholder does not pay self-employment taxes. So I speak about self-employment taxes a lot because it's a tax that's in addition to the tax that you're going to pay just on your individual tax return. And that self-employment tax is 15.3%, or it could be up to 15.3% because it does have the limitations that you have with Medicare as if you were an employee. So for a C corporation, the dividends that you received are taxable. So one thing about a C corporation is that they form a separate, it's a separate entity entirely, and they pay taxes separately. So different from an S corporation, which is a pass-through where that income is passed through to your individual tax return. A C corporation is going to file their own individual tax return, and you're going to pay taxes at the entity level. When you take money out of the C corporation, they give it to you in dividends. Like say, for instance, if you hold stock in Walmart or Apple or Tesla, those are corporations, and you're a stockholder. So when you receive dividends, you pay tax on those. It's the same way with the C corporation. And so that's why a lot of people don't like to form C corporations, because of the double taxation. And again, you would have the capital gain or loss on the sale of any shares, similar to any other, stock transaction. And you can receive a salary as an owner stockholder. So that kind of goes over the entity structure. Anybody have any questions regarding that before I go on?
DeAndre, you want to ask your question?
Yeah. Hey, I'm DeAndre. I'm doing wholesaling full time. So I know one. I'm currently using two different CPAs right now. Not like I haven't done any elections or anything like that yet with them, but one recommends that I like the S corp, and but another one recommends C corp because they said that something like so something won't show up on my 1040 or something like that. So it's just kind of like will it have the same benefits? As far as like, I know you said you can get paid out as a salary on a C corp. So in essence, would a C corp be better if it's going to be paid out on a salary? So the I guess those items don't show up on the 1040.
Well, you can have a salary from either an S corp or a C corp, but with an S corp, and it's a salary, so you have a W-2, right? But with an S corp, you're going to pick up the net income or your share of the total income of the business on your individual tax return. On a C corp, you don't. So think about, Apple. Apple files their tax return and you just receive dividends. You don't know anything about it, but you're a stockholder in Apple. That's how it would be if you formed a C corp. It's a totally separate entity. But on an S corp, you will pick up the income on your individual tax return.
What do you mean by pick up the income? Like, what do you mean?
Because it's a flow-through entity. So an S corp, just like an LLC or partnership, they file their return, and then say, for instance, the net income on the return is $50,000, right? If you are the sole member, or even if you have other people that are in the entity with you, you're going to pick up your percentage of that $50,000. So that's going to pass through to your individual tax return. And that's going to be, you're going to be taxed on that. Did I?
Yep, that makes sense. Yep.
So you're going to be taxed on that portion of it. So that's how it's going to show up on your individual tax return, compared to if you are a C corporation. The C corporation is totally separate. It has nothing to do with you except for the dividends that you receive. C corp also has, at this point, where we are today, it has a flat tax rate of 21% for federal. So some people look at that as a way to lower their tax bracket, because remember, if it's a pass-through, it goes to your individual tax return and it's added to whatever else it is that you have going on. So your wages, your interest, dividends, whatever. So your tax rate could be higher.
Got it. So with the So doing wholesaling full time, like kind of that's basically the primary source of income. So with the C corp, so then we better to do a C corp then?
I can't say that one would be better because I would need to look at your whole situation. You know, taxes are unique to individuals, and this isn't, this is more this is educational, it's not tax advice. So you would need to sit down with someone and let them determine which one would be better for you.
Okay, got you. Understand.
Mm-hmm. But it's based on a lot of different things. So you know, one of them is, you know, how much money you're making in the wholesaling company, salaries. It's a lot of different things that you consider. Okay.
Anybody else have any questions? If not, we'll move on.
So I'm gonna move on. When I did this presentation the other day, I was able to open my Wave accounting. So let me see if I can get to that. But so we'll talk about bookkeeping basics. One of the things that I found is that people start companies, but they don't start looking at the financial aspect of it. So, you know, you'll go out there, you start a company, you know, you're spending money, you're, you know, earning money, right? But you're not tracking the income and expenses. So my recommendations is, besides forming your entity, obtaining your EIN, getting your business bank account, track everything. So even if you have to use an Excel spreadsheet, I recommend a separate, you know, separate business bank account, and you know, you track all your information in there. But even if you're just using Excel for now, just track everything that you're spending, because everything that you're spending for your business is potentially deductible. And that's what you want to make sure that you're doing, is that you're capturing all of your deductions. And of course the income, because the IRS can track that as well once they start, you know, people start submitting forms. But you want to be able to track everything and do it proactively, because it's easier to know what you spent and how you spent if you're doing it real time or within a short period of time, compared to going back and doing it a couple of years later. So track everything, use a software and link your bank and credit cards. So I recommend QuickBooks. That's the software that I prefer, because it's easy to use. It's easy to upgrade. They have a lot of different functions and they've been around a long time. QuickBooks is part of Intuit, and no, I don't get paid for promoting them, but I just like QuickBooks. And you can set it up online, and then you can give your accountant access to the to your QuickBooks account so that they can, you know, monitor things that you're doing and be proactive with it as well. Keep your business and personal accounts separate. That's a big one, especially, you know, when you're forming an entity, and you're part of the reason for forming an entity is the liability separation. So to protect you from liability. So if someone comes and sues your company, you don't want to be sued, right? That's the reason why you form an entity. But if you're commingling your funds, if you're doing everything for your personal and your business account, or everything for your business and your personal account, you can't really tell that it's different, right? Because you're mixing everything. And that's also, they call it piercing the corporate veil. So you want to be very careful that you keep everything separate. And then documentation. So say, for instance, you go out, you know, a big one is, you know, people want to travel for business, right? So you need to document your reason for traveling, you know, what you did, where you know, not where you stayed, because you'll have that information, but what you did, your purpose for being there, you know, just have information to support your expenses. So a big one is, I mean, I recommend keeping receipts for everything, but especially the ones that the IRS is going to question, right? Business travel, meals, mileage, you know, keep a mileage log. And, you know, if you're traveling for your business, or even having to go back and forth with your business. For instance, you know, I had to go to San Diego to pick up my car for a Turo, and I calculated that miles, and I'm adding it to my log so that I know how many miles I have. And I'm not having to go back and recreate or estimate. I have the information on hand. So that's a big one, is documentation. And the reason for that is that it saves time, it's more accurate, and it's proactive. So as your business grows, you want to know where your money is going. Same thing like with the personal budgets, like where is my money going? How much am I spending on supplies? How much am I making? You know, do I need to do something different with my business entity structure? Say for instance, if you're an LLC and you're making, you know, close to $50,000, $60,000, it's like at that point, most CPAs recommend that you convert that to an S Corp in order to save money on taxes. It's just kind of a number that kind of separates that. It's when it becomes more beneficial. But if you don't know that that's where you're approaching, how can you make any changes, right? How can you be proactive if you don't know how much money that you're making? So saves time, it's more accurate, and it's proactive. And then I see a hand.
Yeah, my name is Bruce. I just had a quick question. So once you already have an LLC, like you stated, switching over to an S Corp, is that like how does that process work? I mean, do you have to like purchase another entity, or I mean, how do you convert it?
So if you're a single member LLC, you're a disregarded entity. So the IRS doesn't even recognize you, right? That's why you have to file your that's why your business information is put on your Schedule C, because you're a disregarded entity. So what you will do is, if you are electing to be taxed as an S corporation, you will file a form 2553. Okay. And that's even if you become a corporation, you still have to file the form 2553. And with that, you're just telling the IRS that you that you elect to be paid as an S corporation. I think I skipped a couple slides and I don't know how to go back. That you elect to be taxed as an S corporation. And the timeline for that is 75 days, but there are waivers and exceptions where you can get past that 75 days. So one of them is if you decide that you want to be an S corp, but you haven't completed the form, that when you file your first tax return, you can elect at that time, and then just, you know, make the election and complete your return as if you are an S corp.
Perfect. Thank you.
I had a question about bookkeeping. This is DeAndre again.
Okay.
So I'm currently using Wave accounting at the moment. Is there really a big difference between Wave and QuickBooks?
I can't tell you 100% because I've just started using Wave. I actually, with my Turo, I set up a Wave account, and that's what I kind of gave a demonstration of. But they basically do the same thing. The goal is to actually use it, link your bank account, and categorize your transactions.
Okay, yep. Because I do have a bookkeeper that's currently keeping my books accurate on Wave accounting. And I guess every month they have like a profit and loss he generates for me and keeps it up to date.
Right.
Okay, and also Wave accounting also has, I guess, like a payroll option. I'm not sure if QuickBooks has that, but I know a lot of people go through, like if I want to do the S Corp election, correct? I know, well, someone mentioned doing it through ADP, right? But Wave accounting has a payroll, like kind of like a payroll. Would you recommend doing a payroll through like a software like that, or is it best to just stick with ADP or something else?
You can do it through the software, as long as you're making sure that you're filing the payroll tax returns timely and making the payroll tax payments timely. And I know with QuickBooks, they have like assisted payroll or full service payroll, where you just kind of put in the information and they'll go in and they'll make sure that that's done for you. So it just depends on how you want to do it. But the important thing is making sure that you get it done, you know, especially the reports.
Yeah, I agree, because it said that like it's payroll compliant, I guess. I just didn't know I think there's probably a price difference between like Wave and ADP and stuff like that, but I never used either. So okay, thank you. I appreciate that.
And a lot of I know Paychecks and maybe ADP, they had like a solo S Corp kind of payroll package where they are the payroll companies know that you have to have a reasonable wage and that you have to perform payroll. And they know that, a lot of times it's a single, it's a solo shareholder for the S Corp. So they have packages that are designed so that it's not so as expensive. A lot of times payroll companies will charge you by the number of people. So they have smaller packages where they'll allow you to do that. So just compare, there's ADP, there's Paychecks. I know a new one is Gusto. You can do it through QuickBooks. You can do it, I'm sure, through Wave. And then there's another company called Xero. I haven't really used them, but they're all going to do the same thing. It's just a matter, the biggest part is getting your information in there and making sure that you're categorizing it.
Can you kind of cover W-9 and minimum requirements for that?
Yes. So if you are paying someone, right? So you're in business and you're paying someone to provide a service for you, right? So at the end of the year, if you pay that person over $600 and they are not incorporated, you're going to need to issue to them a 1099 form. And there are penalties for not issuing those forms. So my recommendation is to, when you're paying someone throughout the year, to start collecting that information by the W-9 form. So the W-9 form is similar to a W-4 form that you would fill out if you were an employee. And it basically talks about, it basically asks for your name, your entity structure, and your EIN or your social security number. So I say to people, because it's easier to get information when someone wants their money, right? So before you issue a check to someone, just request that they fill out the W-9 and provide it to you. So then at the end of the year, you're not having to go through trying to find this information. And you can also mark in QuickBooks that it's a 1099 person so that they'll be tracking it for you throughout the year. So it just makes it for easier reporting. And then if you're providing a service to someone as well, then, and you're not incorporated, then, just go ahead and fill out the W-9 form and just have it saved as a PDF so that you can send it to people as they request it from you.
So I had contractors in my last business, and I paid them out through direct deposit. I'm purchased like QuickBooks myself, so I was paying out all my contractors through QuickBooks, through W-9, through payroll direct deposit. So.
Yes, and you can do that as well. And it's like I said, it's easy to pull it all together if you have all the information in one place. So let's kind of touch on the ways that you receive payments. A lot of people receive payments through PayPal or Venmo or Cash App. All of those different things have to be tracked in a sense to make sure that they're hitting the bank account or to see how they're hitting the bank account. And one of the things that I don't like about Cash App and PayPal is that you can pay things out of money that's sitting in your account. So it doesn't always just go into your bank account, right? So say for instance, somebody pays you $500 for a service, and then you go to pay somebody else out $300. That's showing in that PayPal account. That doesn't always hit your bank account. So it doesn't necessarily mean that you're recording it in your QuickBooks account. So it makes for not impossible, but more challenging bookkeeping, because you're having to make sure that you're not double counting, income and expenses. So I like for things to go straight into the bank account. I'm kind of old school. I like it when we used to write checks. You write checks out of your checkbook, you pay it, and you know that it came from that account, and you move on. So you reconcile your bank account that way. And then I'm going to go through this, and if I have a chance, I'll try to pull up my Wave account so I can just show you guys that. So I talk about keeping business and personal separate, and people always want to say, well, how do I get my money out of my business if I'm supposed to keep it separate? So if you are an S Corp or corporation, you put yourself on payroll, right? So you pay yourself a salary. As receiving a salary, it's just like you were working for any other company. So you can set up a 401k for yourself. You can pay for health insurance. It's your company, right? And all of those expenses actually reduce your taxable income. You can also take money out through distribution. So S Corps, when you take out a distribution, like I mentioned before, it's not taxable if you have basis in the entity. So basis is basically the money that you put into the company plus the income that's earned. So say, for instance, you put $3,000 into your company when you started it, and then last year it earned $50,000 in income. So you have $53,000 in basis. So if you take out $50,000, and this is probably too technical, if you take out $50,000, that's not taxable. But if you take out $60,000, then some of that money would be taxable. So the goal is to make sure that you're tracking everything, even, you know, when you're putting money into your company, so that you make sure that you're tracking your basis. And so then you take it out through distributions, or if it's an LLC, you can just take it out through draws. So one thing with draws is, you know, I say don't mix them, don't commingle business and personal. So you can set up where you just take money out of your account periodically. So once a month you take out so much money, or twice a month, or even if there's something that you need to purchase for your personal out of, you know, but you don't have money in the personal, but you have the money in your business, just transfer a lump sum to your personal account and just categorize it as a draw instead of paying for that expense out of the business account. Okay. Let's see. Any questions?
I have another question.
Uh-huh.
All right, so as far as like payroll, right?
Mhm.
So I'm sure there's not like a certain calculation for this, but like as far as creating like a salary for yourself, is that determined based on obviously how much you make that year, or how much you make? So like for example, right? If I made $200,000 in 1 year, right, with my business, right? Like, how would I know how much to pay myself? Like put myself like on wages, like 5,000 a month, 10,000 a month? Would it be based on my expenses? Would it be based on, like, how would I know? Like, I'm just basically right now, I'm just trying to figure out like a reasonable salary for myself.
Mm-hmm.
So is that like something that's more in depth, or is that like a formula?
It's not so much a formula, but it's kind of based on what you would pay someone to perform the same duties that you are performing. So if you say like you're a CEO or COO of your business, it's like, you know, how much would you pay somebody to perform that same job? $100,000, $120,000, and you have to keep in mind that it's based on, you know, the income for your business as well. And another thing with that is that you can always adjust it. So say, for instance, if you start paying yourself, you know, a lower amount, but then at the end of the year, you find that you made more, you can either adjust the salary or you can pay yourself a bonus.
Yeah. So that's exactly what you took it out of my mouth as far as the adjustments. So with the adjustments, I'm sure like for example, like you said, like let's say like I was paying myself low, and then I made a lot of money, so I wanted to pay myself a bonus or something like that. Can you make those adjustments anytime, or is it better to do it at the end of the year? Like, I'm sure no one wants to just keep adjusting like their salary like every month.
You can make those adjustments as you see fit. I mean, if you were an employee and they saw that you were performing well and they gave you a raise, they just gave you a raise, right?
Correct. Yep.
And then there's the difference between owner salary versus owner draws. Those are two separate things.
Right.
As well.
Right. Mm-hmm. So you can even, you know, you may be taking some of it out in salary, but you could still take some of it out as a distribution, you know, in order to get the money out of the entity. But keep in mind that there are different benefits to the salary because, you know, I like to say like a 401k. So you set up a 401k and you take the money out. So you pay yourself a salary, but then you have a 401k that's coming out where it's going into your retirement. So instead of giving that money to the IRS, you're actually putting it aside to yourself because a 401k is pre-tax. So that's going to reduce your income coming to your W-2 side. So it's not something that you can just kind of just make it up out of the sky. You know, it's kind of, you need to sit down with someone and look at everything that you have going on, because when you're looking at becoming paying yourself a salary, you want to look at how it's going to affect you on your 1040 side and what you can do in order to make adjustments so that it all balances out. You can use distributions to pay your estimated tax payments, or, you can have more withholding coming out of your paycheck so that it looks like your payments are made throughout the year instead of at one time, so it's just different things that you can do.
And I have one more question. I guess this is more with kind of more like deductions, or like what's considered a business expense, I guess. So like for as far as like so let's say I actually run my business from my apartment, right? Where I'm paying rent at currently, right? So like my home, like my rent where I'm renting at is kind of my office. So would I run that through my business or personal? Or can it be both? Or is it kind of one of those like gray areas where it depends? Because I'm in a position now where it's kind of like not sure whether I pay my rent with my operating account or pay it with my personal account. So what is kind of your opinion on that?
So pay it out of your personal account because it's actually a personal expense, but you can have a deduction on your tax return for the portion of your home that's being used for business. And keep in mind that it's supposed to be a separate area that's designated specifically for the business. So like in my house, I actually have an office, right? So, and this is dedicated specifically for the business. So I would be able to take that square footage of my office compared to the total square footage of my home, and that percentage of my expenses, I would be able to deduct or put on my return as a deduction. And it differs the way you handle it between a Schedule C and an S Corp. So that's something to keep in mind too, but you definitely want to track the information.
Okay, thank you. Appreciate it.
You're welcome. Any other questions? Okay, so common forms issued and received. I think this is where we touch on. So the W-9, the request for taxpayer identification. Again, I suggest that you request those. Anybody that you're paying, just request it. And if you don't need it, it's better to have it than to need it and not have it. Because come the beginning of the year, you're trying to gather all this information. People aren't as responsive as you may want them to be. And there is a deadline. So, you have until January 31st in order to issue these out. And you don't want to be chasing people. Like I said, people are easy. It's easy to get information from people when they're wanting to get paid than it is when, your job has been completed. And I won't say when you're wanting to get paid. It's like, it's easy to do things at the transaction when it's going on compared to later. So, and that's just how it is with anything. The 1099 miscellaneous are issued at the end of the year. So you should be issuing those to anyone that you pay over $600 if they're not incorporated. 1099K for third-party payments received. So a lot of people are selling courses or doing things online, whether it's through Gumroad or Thinkific or, Shopify. So if you're receiving third-party payments, you're going to receive, and that amount is over like $20,000, you're going to receive a 1099K, and the IRS is going to get a copy of that as well. So you want to make sure that you include all of that income on your return. And another thing with that is, one of the reasons why I recommend tracking during the year is that these companies charge fees. So your 1099 that you get at the end of the year may be different than what was actually deposited into your account. But you need to be able to track your fees and know what's a fee, which is an expense to you compared to what is income. So, and it's easier to do it as you go through the year with each transaction than kind of waiting until the end of the year. And, things happen, Gumroad activity is frequent. So, you want to be able to track that throughout the year. And even like PayPal has fees. And like I mentioned, PayPal, something may be paid out of your account, but not out of your bank account or out of your PayPal account. So you want to make sure that you're tracking all that so that you have good, accurate numbers. A W-2, if you're an employer, you're required to issue those to your employees at the end of the year. And then another one that comes up is a lot of times people will go into business, right? So it's like, hey, you and your friends start a company and you guys just start doing business. Or people will say, let's all chip in and purchase this asset, or let's all chip in and do this. So if you're doing that, you have you form a partnership, or you have an entity, and you have to report each person's share of income and expenses for the year. So make sure that you're getting your partners, or shareholders' name, address, and social security number, so that you can provide accurate information. So other things to consider. So sales tax, if you are online selling not digital products, but tangible products, you may be required to collect sales tax. And there's a case called Wayfair, and you may not just be required to pay sales tax in your area, but the area where you're shipping your product to. So you want to keep in mind, keep that information up to date as well. So if you're doing things and you're collecting a lot of sales tax, that's another thing you need to consider, maybe a different program that you need to implement in order to track that information. And then if there are any taxes specific to your business, say for instance, if you, I know like with trucking industry, they have to pay, in California, it's a IFTA tax, I believe, where you have to report the gas that you purchased in different states and the mileage that you used and the number of states that you went to. So there's additional information that you may need to be tracking. So keep that in mind when you're doing your business throughout the year, because it's easier to file it throughout the year. Compliance filing with the Secretary of State. So like in California, you have to file your updated statement of information either at least once a year. And in California, if you don't file that, you can get a penalty, and they'll suspend your entity. And it's a long process to go through it. So if you formed an entity in California, make sure that your statement of information is up to date. And then payroll taxes. So that's another big one if you have payroll. So financial statements, you mentioned it, the profit and loss, and then the balance sheet. So the profit and loss is going to tell you what you're making for the year. And then the balance sheet is going to tell you kind of like where you stand. So the balance sheet is going to show you like your total assets compared to your total liabilities and equity. Good to know what those numbers mean, so that you can, properly run your business. So I don't think that it's important for a business owner to know all the fine details, but you should know what the numbers mean, especially like what your profit is, what your gross profit margins are, how much you're spending on different things. So that's something good. And in Wave, you can pull up the report. Wave and QuickBooks, it's very easy to pull up that report.
Can you cover the importance of connecting your bank account to products like that?
I can. I'm trying to see how to, if I can go into my Wave account. So let me just see. So I like, am I here? Sorry, I meant to have this up, Daniel.
You're fine. I'd never heard of Wave till you mentioned it on the last time you did your presentation. So I'm a big fan of QuickBooks, and that's all I use.
Yeah. I could show you QuickBooks. Did I close out my program? Did I close out my thing? Can you still see my screen? Oh, there we are.
Yes.
I could show you QuickBooks easier than I could show you. I don't know if you guys can see that.
Hey Daniel, Wave is just like QuickBooks, except there's no monthly fee. Like QuickBooks has a monthly fee, Wave doesn't. That's really the main difference.
And QuickBooks has multiple levels. So like you can start with, they have a self-employed plan, and they have an app. And one thing that I like about QuickBooks is that it can, it tracks your mileage. And then it also kind of tells you estimated tax payments as well. Like what you can expect to pay. Let me see. No. Sorry guys, I'll have to do that on another day. I have there's just so many passwords and oh, okay, we may be in luck. I have so many passwords. I need to actually put in. There's a program called LastPass. I don't know if you guys have heard of that,
Yes.
but you're supposed to be able to put all your passwords in there. And I need to set that up because there's just too many passwords. Okay. So let me see if I can get in.
So what's the name of it? You said LastPass, like
LastPass.
LAST or LASS?
LASTPASS, LastPass. I use it a lot. It works great. You can share passwords with VAs and stuff like that, and it won't actually show them the password. It's great, and there's a free version too. One thing I will mention about connecting your accounts to this is instead of manually putting every expense and every income, you can automate that. That's why I like QuickBooks. I don't know if Waze is the same thing, but you can automate similar transactions. So if you have a monthly transaction that goes out every month, you can categorize that as a certain expense, and every time it comes in, it'll automatically categorize it. So once you use your account for 1 to 2 months, 3 months, if you're using the same transactions over and over again, you only have to check it once a month, and only edit whatever new transactions you did during that month, and categorize those correctly. And that helps with your profit and loss because you can pull up your whole profit and loss. You can see what expenses you're spending where, and you can tag them like, hey, this is marketing. This will be texting. This will be whatever type of marketing under that subcategory. So you can create subcategories of all your expenses. That way you can get like a fine detail of all your expenses going outbound versus inbound, where the income came from, what type of income it came from, as far as if it's direct deposit or payments coming in from Stripe or whatever it looks like.
Right. You can do the exact same thing with
Wave.
I think.
Yeah, I'm not sure if you can do it with Wave, Daniel. The bookkeeper I use, I mean, every time I get my statements, I just send it to him. He goes in and he does all that stuff himself. So I'm not sure.
I got you.
It's better. I like to link it because it pulls all the transactions in.
Yep.
So, and then all you have to do is just categorize them, and you can, like Daniel was saying, you can set up rules to where if you have something that you're paying, you can make recurring transactions, or you can like set up rules so when things come in, it'll automatically pull it in for you. And then the reporting is good, and you can set up an external accountant where they can go in and take a look at it as well and make any adjustments.
Yeah. So there's a lot of benefits to setting up something, even a free account like Wave or doing QuickBooks. I recommend everybody in business should have some way of accounting, just because it'll save your CPA a whole lot of gray hairs.
Oh, we need to edit that out and let you be the poster child for for accounting, because that's the thing. It's like it saves so much time.
Yep.
And then it's at that point your CPA can help you to make sure that you're implementing proper tax planning strategies, or you're paying yourself enough instead of having to get down into the weeds in order to see what's going on.
Do you have more in your presentation?
Let me see.
Everybody go get a free account at Wave and look for yourself.
Yeah. And the password, and then my phone is not here. So so with tax planning, so you want to annualize the expected income for the year, and that's kind of like when it's like, say, this point of the year, you want to kind of get an idea of where you are and then what you are expecting, so that you can look at what that's going to look like for you, and see if you need to make any estimated tax payments or anything that you can do in order to save money. So it's making recommendations for ways to reduce your liability or cover taxes due, and then calculating estimated tax payments. And then what changes you can be made going into next year. So if you're okay for this year, but you're anticipating you're going to be making a lot of money next year, then you can, maybe you need to change your entity structure, or maybe you need to do something different. So that's kind of what tax planning is about, and looking to see if there's a different structure. If maybe you have an LLC and you're going to do something different, maybe you need like, some people do like a holding company for one thing, and then you have an LLC for something else and an S Corp for something else. So that's kind of all where the tax planning and the tax strategies come into play. So be proactive, have good financial records so that you know your total income and expenses. Contact your CPA or tax professional to see if you need to make any changes. That's important. Having someone that you can trust and you can discuss things with, it makes a big difference. And ask questions to learn more, and review your return before you sign. So that's a big one too, because a lot of people are not knowing what's on their tax return. It's like, say we just prepare the return and we sign it and we send it off because that's what my CPA told me. It's like, that's not good to know. You need to know what the numbers mean on your return. If there's something that you could do different going forward, if the numbers make sense, from a business standpoint, if they have on there that you had, $100,000 in salaries, but you had no employees, it's like, that's something to think about. So just being proactive and knowing what's on your return.
I'll make a recommendation too, is that if you're doing any type of business, get a CPA. Do not use TurboTax. Do not use any of those other programs. Get a CPA, because the CPA is going to make sure you're taking care of your tax liability wise and try and get you the most deductions. Whereas if you're talking to TurboTax or all these other random H&R Block, there's another one that everybody uses. Right. Do not use these type of companies if you're in business. Just don't do it. Get a CPA. It's probably, I don't know what the pricing is, what CPAs. I honestly don't know what my CPA charges me. I just signed the thing, and that's probably where I go wrong. They take it out of my tax return. And like, honestly, I've been using my CPA for 5 years now. I don't even know what he gets paid.
Oh wow.
I know he saves me more money on taxes, and as long as he does that, he can take whatever he wants.
Right. And another thing with using a CPA compared to H&R Block or like TurboTax, you're doing it on your own, and you can call in and ask questions, but that person won't be there the next time you make that phone call, right? You're going to talk to someone different. And at H&R Block, it's like, you never know who you're going to get when you go in there. So you want to, especially if you're in business, you want to develop that relationship, because it's not just the tax return, it's the relationship throughout the year and going forward.
Yeah, and the good CPA will take care of your best interests at heart. Yes. We do have a question that was sent to me before the call because she wasn't able to make it. It's from Sharonda. Her question is, how do you categorize transactions from a outright sale of a property or from owner finance? Because some of these, we work with a lot of real estate investors, and they might carry a note of the property. Mm-hmm. And that's her question, is how would you categorize a owner finance note where you're getting payments for the property and purchase price versus a actual outright sale of the property?
So if you are carrying the note, then you're going to have interest income that you're collecting from the person. Looks like she's trying to get in the room.
She just joined in. Sharonda, are you there? Sharonda, I just asked her a question. That's funny. She just jumped on. Mm-hmm. Sharonda, we just asked your question. She's answering it right now.
Okay. So if you are carrying the note for someone, then you're collecting interest. So you're going to report on your individual return interest income, and you're going to issue to them a 1099 for the interest that they paid to you. Similar to like a bank, if you had a mortgage, you would issue them a 1098. So you will issue them, it's a 1099 form for interest income that they paid, right? And then you'll put that information on your return as an income. They'll pick it up as their expense. If you were to sell the property, then it would depend on, like as far as recording it, it depends on, are you a real estate investor? Was it just like a property that you were renting? Is it a property that you sold that you purchased as a flip? How is that?
Sorry, I'm so late. I'm guessing that was me, Daniel, because I just heard. Okay, so sorry. Okay, so that's the thing. Sometimes when we acquire a property, we don't know, and that's one of the things I was like, okay, when I put it into my accounting, am I going to hold this? Because the thing is when I buy to flip, I'm treating it like inventory. But if I'm holding it, then I'm like, wait a minute, what if I end up flipping it within 6 months, or they pay it off? Was that inventory, or you know what I mean? And then some people are doing where there's 0% interest so that they don't have to do the 1099. I'm learning that now. I don't want to do any more of those. So, I have one that I do have interest on it. And so that process, like right now, the way I put it in as though it was inventory, but I'm wondering, should I have put that in as an asset or as inventory?
So, but you sold that one.
It is technically sold, but if they default, it's back with me.
She sold it on a contract. So once the payments are paid in full, she'll transfer over title. So technically she's still the owner of the property, even though there's a contract stating so.
So then that would still be an asset. It would still be an asset, and then you would again report the interest as the income, and then give them the statement of the interest that they paid. So
that's the other thing. Like when I don't have it, because don't have it set up right now. I have the whole payment just coming in, and it's all going into one account on my accounting system. But to differentiate, when the payment comes in, and see, I have everything is automated. When it comes in, it's just I have to go into an account. But I can go to like my amortization schedule to see how much interest is for the year. And then like at the end of the year, I can like make a journal entry to show this was actually interest. Is that the easiest way to do it? Okay,
you can do it that way, or you can do it monthly. Yeah.
Yeah, I want to just do it one time and not have to do it every month. So if that makes more sense, then I'll do it that way. Just once a year, go back to my schedule and show what's interest, and then send them a 1099.
Right.
Okay.
You can do it that way. If you need to have more accurate records, then you would want to do it monthly, just so that you know what your interest income was compared to that total amount that's coming in. But you can do it once a year. And then as far as the other properties, I would categorize them with the way they are intended when you purchase them. And then if that changes, then make adjustments then. So if you purchase something that you're intending to hold as an investment, then I would put it as an asset. You know, if it's something that you're intending to flip, then that would be inventory.
Okay. Is there a time frame that you would say, because if I'm converting it to inventory, what's the journal entry from converting it from an asset to inventory, or vice versa?
You would credit the asset and debit the inventory.
But when you name them, so in like my system, maybe it's because I'm the way that I do things. When I'm naming it, should I name like and the thing is that sometimes I attribute expenses to the asset, and I'm trying to keep all that organized. I guess the best way to say it is like I need a roadmap to keep it all together. So if I'm converting it from the asset to now an expense, I don't want to have to create a whole new, I think, never mind, I've just figured it out in my head. I'm just going to create a whole bucket for expenses associated with the asset. I get it, never mind, I'm sorry.
Right. And then with like, if you are making improvements to your asset, then that's going to increase the value of your asset. If you're doing things for a flip, then that's going to increase the basis of the flip, meaning that you're going to take the cost plus those improvements, and then that's what you're going to deduct from the sales price and pay tax on the gain. So it's inventory, so it's cost of goods sold. So, you know, anything that you're doing to that property, because so I have a client that's doing a flip. So it's like we recorded the purchase of the property, and then anything that's done, and the purchase of the property is a cost of goods sold, right? And then anything that's being done to that property and preparing it to sell is being added to that cost of goods sold account. And then we will, when the property is sold, then we'll, then we'll just have the sales. So you have the sales minus the cost of goods sold, but we're kind of putting it like in classes so that we can see exactly what we made from that particular property.
Okay, that's how I was doing it, but I thought I was being elementary with it, but okay. That makes sense. Okay.
And feel free, I don't know if my contact information, so here it is, but feel free to reach out.
Okay. Do you,
If you
I'm
want to.
using Wave. Have you ever heard of Wave, the Wave software? Do you have any
Yes.
criticisms for using that, or no? I mean, because I hear a lot of people talk about the other ones, but I'm enjoying it, but it makes it, I don't know, maybe I'm lazy or something, but it's all automated.
If it works for you and if it gives you good, accurate information, if you're tracking all your expenses and activity in it, then I'm fine with it. You know, and most CPAs or accounting professions will tell you, you know, as long as it's doing what it needs to do and you can use it, then it's fine. You know, it may come a point where you may need to upgrade to do something different, but if it's working, then go for it. And
Okay,
and that's the
thank you.
purpose is you want to automate it and you want to be able to say, hey, I can do this, right? You know, so then you
Right.
can, you know, complete the
Oh,
information. Yeah,
well, thank you. I really appreciate it.
you're welcome. You're welcome. I see a couple hands.
Go ahead, DeAndre.
Yeah. So kind of, this may be like a two-part question. So here we are in the month of July, and let's just hypothetically say, let's say I wanted to like do like the S corp, correct, right? Is there a certain date that has to be done? Like for example, if it wasn't like done at the beginning of the year, right? Like kind of in the position now, like just with a regular LLC, and let's say I want to do the S corp election, let's just say in the month of August, like how does that work? Does it have to be at a certain time, or is it kind of, do I have to just kind of pay taxes from January up until now? Just like how does that work? I'm just trying to figure that out.
So if you're an LLC and you want to elect to be treated as an S corporation, you can do that and say you want it as of a certain date, right? So say, you know, a good time would be the first of the month. So say August 1, and then you just start separating things as of August 1 and operating like an S corporation at that point. So you would need to file 2 different returns for 2021. So if you're an LLC, you know, you report part of that income on that return up into, you know, through the end of July, and then you would do the S corp starting August 1st.
Oh, so it'll be basically paying, so it'll be two different set of taxes, and so I'll have to pay the taxes on the LLC, kind of with the LLC from January to July, then everything from August on up, it'll be two separate tax payments then, correct?
2 separate tax returns, the payment. So keep in mind that an S corp doesn't pay federal tax. It's a pass through. So you would pick that up on your individual return, but you would be making the tax payments for both of them.
Okay, guys. So basically, so if I elected the S corp, let's say August 1st, I can't backtrack it to January. Basically, is what you're saying.
No, you can't. It would be, you know, you can't, but there are people that will say that there's probably a way that you could have done it. So I'm not, somebody was trying to get in. I'm not, I'm not big on going backwards. I kind of like to go proactive because I don't like to do anything that's going to make the IRS, you know, question. So, but I've been told that there's a way you can do it, like say it was a management company or something, management fees that were paid to the corporation from your LLC, or you intended for it to be there. Or you, like one of them was a cash and one of them was accrual basis. So there's different ways to do it. I think it would be a matter of what would be like the real benefit of it and what type of numbers we're looking at. Because some things is, you know, it's like the cost benefit. Is it really worth doing this if it's not going to result in a really big tax difference, or if it's going to be something that's going to you know, be like a red flag?
Okay, thanks.
You're welcome.
All right, go ahead, Wayne.
Hey, how you guys doing? This is Wayne. I had a question. It may be a little complex. I started a single member LLC, which was set up wrong in the beginning and set up as a partnership. I got all of that straight, elected as an S corp, and then now I'm amending my articles of organization to take on partners, and my partners only will be entitled to like 75% of the company.
the 30% or the 25% left over would be basically for like R&D or like, you know, investment. And I'm trying to figure out is it more purposeful to just go ahead and just make it an S corp completely, or continue with the LLC elected as an S corp?
So those are pretty much the same thing. So the biggest, it's you're electing to be taxed as an S corp, so that's where it kind of comes in. So there's like a legal entity and then there's the tax entity. So legally, if you are an LLC, then that's your entity formation. If there's multiple people, then it could be a multi-member LLC or it could be a partnership. But the way you're taxed is the tax part of it. So I'm not sure I understand what you're trying to accomplish.
Well,
Or if I
I'm
got
trying to.
everything.
Ultimately, I want to stay compliant. I think I just had to file the 1120S, and I just wanted to make sure that even though amending the documents and all of that, that I wouldn't run into any problems with the IRS.
No, as long as you have the documentation in place, I don't think so. But so are you a real estate investor, or what's your reason for wanting to be an S corporation?
Yes, I'm a real estate investor, and I've taken on partners who are also real estate investors. Some of them are realtors, and we are attacking some of the multifamily spaces and different classes in commercial, and we just wanted to make sure that when these deals go through, that the right amount is allocated towards taxes and capital gains and all that other stuff, and that we are compliant with the IRS and being taxed as either the LLC elected as the S corp, or should we just go ahead and do the full S corp and just have the entity classified as that. But as you were saying earlier, that they're one and the same once you make that election. So I get that part, but I guess I'm just trying to figure out. I guess the next step would be, should we become a C corp or stay taxed as an S corp?
So let me just say this, because it sounds like we should probably have a conversation outside of this, but I want to say that if you're holding property in an entity, it's not recommended that it be in a corporation. So and because it has to do with the appreciation of the property and the way that you can, the entry and exit of that type of entity. So if you are actually going to hold property in that entity, I would recommend that it would be either an LLC or a partnership, and probably a partnership, because it's easy to kind of the partnership rules for buying a partner out or admitting a new partner it's easier to manipulate. Okay. So that would be one recommendation. And then you may want to have two different entities, where you have one entity that holds the property, but then you have another entity, which is an S corporation, that kind of manages the property, the other part of that. So say, for instance, you said something about R&D. So maybe 75% of it is owned by the partners, but then 25% of it is owned by the S corp. And then you have the S corp that works in conjunction with the other entity.
Okay. I'm sorry, I got one more question. Because you touched on the partnership part, and we discussed with the lawyer before about that, and she was basically saying that it's kind of antiquated, the LLPs, and that most people just go with the LLC. What's the difference in the taxation between the LLP and the LLC?
It's the same. It would be the same, because it's going to be a pass-through entity. So you would pass through, your portion of the income and expenses for it. There may be different rules as far as how something is taxed or how it's admitted or like I said, a partner coming in or buying a partner out, but it should be pretty similar.
Okay. Okay. Thank you. Thank you so much.
You're welcome.
That was interesting. I'd never heard those that many questions, so that's something I didn't know. So I appreciate that. Anybody else have any final questions, final thoughts? Forever hold your peace.
Hey, Daniel, I feel like I got a million questions. I'm just trying to find the most important one.
All right. We'll give you about 30 seconds. So if anybody wants to get a consultation with her, I put a link in for her Instagram in the chat box. It's at MLMCPA on Instagram, and you can reach out to her if you have any further questions or want to set up a consultation with her. She's definitely very knowledgeable. Hope you got your question, DeAndre, because you're up.
Yeah, so I guess I guess I have a question about, I guess this is more about tax planning. Like for example, if you use a CPA and I guess like you have like a consultation with them, or like and as far as like the tax plan, what if you don't necessarily like the plan? Like for example, I spoke with a CPA and she recommended, hey, I think that it would benefit you to put, some money into like a solo 401k. I don't see an issue with that, but me personally, I don't want to personally put money in a 401k. So like with the tax planning, is that kind of like a mandatory thing, or is it kind of like what the client wants to do versus what they don't like? How does that work with the tax planning?
It's also ultimately up to you. We're just going to tell you different things or different options that you can do in order to reduce your tax liability, because that's the goal of tax planning, is to know what to expect, and if there's anything that you can do in order to reduce your tax liability, or to be prepared for the liability that you're going to be incurring. It's like it's not a good thing to go through the year, and then it's like comes January, it's like, oh, you owe $300,000 in taxes, right? Or you owe, let's even go $10,000 or $20,000 in taxes, compared to if you had sat down and talked to someone and you knew that this is what was going on and you had the opportunity to make changes, and then you could proactively move forward. So it's just an appointment, and it's just a time to look at everything that you have and see if there's ways to make changes. And it's all based on what it is that you want to accomplish and what you want to do. But there are benefits to putting money in a 401k. If you're looking at reducing your tax liability, then that could help. But maybe she just didn't explain the whole picture and how it all kind of fit together. So that could have been a reason. But then you also have to take into consideration your reasons for wanting to do or not wanting to put money in a 401k. And maybe there's another option.
So can we kind of brush on this Roth IRA? So with Roth IRAs, you have a limit you can put annually. 401ks, you can put, I don't know if there's a limit on 401ks, but
there is a lot more. There is a limit. For 401k, it's probably it's over $20,000 for 2021. I don't have that number right off the top of my head, but it's over 2021. And then they have catch-up contributions. But another thing that you can do as an S corp with a 401k is that you can have like a profit sharing. So I have a friend that's a CPA, and she set up her S corp. She is intentional about setting up her S corp this year because she could put more money aside for retirement. That was her whole goal, was to put more money aside for retirement, compared to if she was in another entity where she could probably put like $20,000. I think with an S corp, she's able to put away maybe $50,000. So
if you're a high income earner, you can do different strategies just by entity or organization, 401ks, Roth IRAs, where you're limiting your tax liability without having to pay that in taxes, just by adding in different additions into your tax planning to limit your full income to the IRS.
And with the Roth IRA, it has an income limit as well. So if your income is over a certain amount, you can't make that contribution.
But that's to a certain point as well, as far as it goes back to your disbursements and your regular income, right? Because you can still get paid in disbursements and regular income, and that still falls under your guidelines as a Roth IRA max income requirement.
Right. Right, because distributions are not taxable.
Correct.
So the distributions do not show up on your tax return as income.
Perfect. So if you take anything away, talk to a CPA. You'll save a lot of time and money.
Yeah, Daniel. I think I think the biggest concern with me with like the 401ks and the Roth IRAs and stuff like that. I think a lot of them are like qualified plans, so a lot of them are tied to the stock market per se, like assets under management, right? I think I'll be a little bit more open to like non-qualified plans. They're not necessarily tied to the market based on, if the market is up, then my retirement is good, and if the market is down, then my retirement is trashed out. So I think that's kind of like one of the main things that I'm currently thinking about all the time. I don't want my retirement to be based on if the market is good or bad.
Well, you can always.
I'm sure they have different ways that you can
Yep.
allocate the money that's going into your 401k, and you also have to realize that it's not the only avenue, it's just another one. So you have other options that you can use, but this one is an option that you can use that's going to help to reduce your tax liability.
Yeah, and
So,
like you can even go the self-directed IRA. Well, it's not necessarily putting it somewhere else. You can throw some funds into the self-directed IRA and then use that for whatever you want, whether it's real estate, earnest money, or whatever you're trying to do in real estate transactions, and you can still leverage that money in a self-directed IRA. So not all these retirement plans go to the stock market. It's really up to you, and that's where you come and talk to a professional that can guide you in the right direction of what strategy is going to work best for you, because not everything goes to the stock market. And that's the difference between a W-2 job and being a business owner, is that most W-2 jobs are like, oh, put it in the 401k into the back end of the company because it was the company match and all this stuff. And they want you to put part of your retirement incomes back into the company that you work for. It's crazy. That's another story.
That's another story. Yeah. And keep in mind too that if you're a business owner, you can match your 401k. So you can say that same 6-7% match that your employer would do, you can do that as the employer and as a tax deduction. So
it's just you're the boss.
You're the boss. Yep, it's your company.
DeAndre, do you have any children?
No children. I got nieces and nephews.
Oh, never mind.
All right. Well, we went longer than intended, but I really didn't want to stop the flow because there was a lot of good creative questions that we had at the end. So I think it was well worth going the extension. We do appreciate your time, Ms. Marjorie. And if anybody, like I said, anybody wants to reach out to her, she's at MLM CPA on Instagram. I dropped the link in the chat, and I'll put it under the YouTube channel. And you guys can watch this again later on, or set up a conversation directly with her.
Thank you guys so much. Thank you for having me, Daniel. It was a good, a nice group. I like it. I like real estate investors. So if you have any questions, feel free to reach out.
Maybe we'll have you come back in a few months. Who knows?
Sounds good.
We appreciate you all. Have a good day.
Thank you. I appreciate it. Thank you.
Yeah.
You're welcome. Thank you.
Thank you. Thank you.
All right, you all have a good day. Our next call is Thursday at 7 Central, so we'll see you all then. We'll get a next text notification. You all have a great day. Have a good Monday. Bye.
You too, Dane.